Imagine hearing the sound of a glass shattering at a party. Everyone freezes, wondering what just broke. It's sudden, dramatic, and impossible to ignore. That's exactly how the market reacts when the RSI breaks a trend line. It's a moment of clarity, a signal that something big is happening, and if you're ready, it could lead to your next big move. In today's video, I'll show you how to recognize these trendline breaks and use them to your advantage. Let's dive in. What is a trend line? A trend line is a straight line that connects two or more price points on a chart, serving as a visual representation of the market's direction. Traders use trend lines to identify the overall direction of the price. Whether it's moving upwards, bullish trend, downwards, bearish trend, or sideways, consolidating or ranging market. In its simplest form, an uptrend line is drawn along the bottom of identifiable support areas, often called valleys. This is known as an ascending trend line. For a downtrend, the trend line is drawn along the top of identifiable resistance areas, or peaks. This is known as a descending trend line. When the market is not trending in either direction but is instead consolidating, a horizontal trend line can be drawn to represent support or resistance within the range. However, technically, there is no such thing as a horizontal trend line in the traditional sense. It's more accurate to refer to these as support or resistance levels. How to draw trend lines effectively. 1. Identify the trend. Determine if the market is in an uptrend, downtrend, or sideways trend. 2. Connect the significant points. For an uptrend, draw the line along two or more higher lows. For a downtrend, connect two or more lower highs. The trend line should touch as many price points as possible without cutting through the price action. 3. Extend the line. Once the trend line is drawn, extend it into the future to anticipate potential support or resistance levels. By following these steps, you can effectively draw trend lines to aid in your technical analysis. What are RSI Trendline Breakouts? Just like on price charts, you can draw trend lines on the RSI to track momentum trends. These lines can act as key levels of support and resistance within the RSI, helping you spot potential shifts in market momentum. How to draw RSI trend lines. Look for peaks, high points, and troughs, low points, on the RSI. Connect two or more peaks to form a resistance trend line, which shows areas where momentum struggles to push higher. Connect two or more troughs to create a support trend line, which shows areas where momentum finds a floor. For example, we can identify an uptrend in the RSI by drawing a trend line connecting the lows. As momentum starts to fade, the trend line is eventually broken. Once the RSI's upward trend line is breached, momentum weakens further, causing the RSI to shift into a downtrend. This is accompanied by a simultaneous decline in price. In the next real market example, a downtrend in the RSI becomes evident by connecting the peaks. As momentum picks up, the RSI breaks out of its downtrend, signaling a potential shift in market dynamics. This is accompanied by a simultaneous rise in price, confirming the change in momentum. Understanding breakouts. A breakout above a resistance trendline on the RSI signals increasing bullish momentum, suggesting a potential upward price move. A breakout below a support trendline indicates growing bearish momentum, suggesting a potential downward price move. How to trade RSI trendline breakouts. 1. Confirm with price action. Combine RSI breakouts with price patterns to increase the accuracy of your trades. For example, if the RSI breaks below a support trendline and the price forms a bearish candlestick pattern, like a bearish engulfing, this confirms a sell signal. If the RSI breaks above a resistance trendline and the price forms a bullish candlestick pattern, such as a bullish engulfing, this strengthens a buy signal. In this real market example using Tesla's chart, the RSI illustrates a clear downtrend, with a downward trend line identified by connecting the peaks. Once the RSI trend line is broken, momentum begins to shift upwards. Simultaneously, a morning star pattern forms on the price chart, signaling a bullish reversal at the end of the downtrend. The alignment of these two key signals, the break of the RSI trendline and the formation of the morning star pattern, strongly suggests the onset of an uptrend, which is confirmed by the subsequent price increase. 2. Use support and resistance levels. Align RSI breakouts with key support and resistance levels on the price chart for additional validation. A breakout on both the RSI and the price chart can signal a stronger trend reversal or continuation. Bearish scenario. If the RSI breaks below its support trendline and the price also falls below a significant support level, it confirms growing bearish momentum, signaling a strong sell opportunity. Bullish scenario. If the RSI breaks above its resistance trendline, and the price also breaks above a key resistance level, it confirms increasing bullish momentum, signaling a strong buy opportunity. This chart illustrates GameStop's stock performance as a real-world market example. There is an upward trend in the RSI, identified by connecting the troughs. When this upward trend line was broken, momentum began to decline. Simultaneously, on the price chart, we observed the breakdown of a key horizontal support level, which had previously been tested and held multiple times. The confluence of these two signals, the RSI trendline break and the breakdown of horizontal support, indicates the beginning of a bearish trend. As shown, the price declined following these events, confirming the bearish signal. 3. Combine with divergence analysis. Use RSI divergence to strengthen the reliability of trendline breakouts. If a bullish divergence, price makes lower lows while RSI makes higher lows, occurs near an RSI resistance breakout, it can signal a stronger reversal and a high probability buy opportunity. Similarly, if a bearish divergence, price makes higher highs while RSI makes lower highs, happens near an RSI support breakout, it can confirm a stronger sell signal. This is a real-world market example showcasing a gold chart. We can observe a downward trend in the RSI, represented by a trend line connecting the peaks. Once this downward trend line on the RSI was broken, momentum started to increase. At around the same time, a regular bullish divergence appeared. While the price made a lower low, the RSI recorded a higher low. These two signals, the RSI trendline breakout and the formation of a regular bullish divergence, serve as strong indications of a potential upward trend. As shown in the chart, the price subsequently rose following these signals. Alright, we've reached the end of today's video. If you found it helpful, don't forget to like, subscribe, and comment below. Next time, we'll explore the importance of the 50 level on the RSI, so make sure to subscribe and turn on notifications. See you in the next video.